Hello, everyone. Welcome to the Unlocked Tuesday live stream. We are here every single Tuesday, 2 o'clock Eastern, bringing you all sorts of topics from all walks of real estate. I help people buy and manage long-term rentals, and a huge part of that is understanding how to save on taxes. So we have with us Troy Becker. He is a 1031. Are we saying custodian? Tell me again.
It's a qualified intermediary.
A qualified intermediary who specializes in a 1031 exchange, which a huge benefit is tax savings. So I have some questions for him. I'm first going to let you, Troy, introduce yourself, and then we will hop into it.
Yeah, thank you. I am Troy Becker. I'm the president at 1031 Exchange Corporation. We're based out of Austin, Texas. We've been a company since 1991. And yeah, we do exchanges all across the country, and it's all we do. So we're not an attorney. We're not an accountant or a law firm. So we specialize just in one thing, doing 1031 exchanges.
Awesome. And the way that you and I connected is actually through my real estate agent, and we just used Troy for a exchange from an Austin property, and we moved that equity into Central Ohio. So I think you guys have seen some of that on my Facebook group. I was kind of letting you know that we were doing that. So Troy and his company facilitated our 1031. It was an absolutely smooth process. Very, very pleased with how everything went. So I figured let's bring him on, introduce him to the community. So as you guys know, this is super interactive. If you have any questions, go ahead and put them in the chat, whether you are watching live or watching the replay. If you tag me or Troy, we will get your questions answered. So let's hop into it. First, a lot of you are probably here and you're like, what the heck is a 1031? Why do I care? So tell us, what is a 1031 exchange, and how do kind of investors use this product?
Right. So a 1031 exchange is a section in the tax code that allows an individual who is selling an investment property to roll those proceeds into another investment property, and they can defer the gain as long as they're spending equal to or greater than what they're selling for. And so that's kind of the tool, is instead of paying the taxes on that gain and giving that money to Uncle Sam, you get to use those extra dollars to increase your investment on the other side. You could leverage it and buy a better investment property.
Yeah, exactly right. So how would the process actually work? If I say I'm your investor, mm-hmm. and I am considering selling a property, what do I do first?
Right. So the first thing I always recommend is to contact a qualified intermediary like us. They really should be able to walk you through the process, listen to your situation, and understand if it's going to work for a 1031 exchange. That's probably the most important thing from the get-go, is because we want to know exactly how to structure it. And then from that point on, we just need to get connected with the title company or the attorney, whoever's closing that sale for you, and we'll work with them to put the exchange in place.
Yep. So one key thing that I wanted y'all to pick up on is you contact them before you actually sell the property, right? Yeah. So if you just sold a property, it's too late. This has to be something that you have in place at the time that you sign the closing documents.
Correct. Yeah. And we can set it up last minute if we need to. But again, the more time we have ahead of time or ahead of closing to get that planning done, it's better for us.
Yeah. Timeline wise, when you and I first connected, I think we had a couple weeks to closing. I thought that I was late, and you said, give me 7 days. And I was like, okay. Yeah. So they can set it up pretty quick, but at the same time, just, general professional respect is as much time as you can.
Yeah. And it's better for you also to, not jump right into it.
Yeah, exactly right. Okay. So I decide I'm selling a property. I contact you or another intermediary, and what do I do next? What do you need from me?
So again, you get a contract on that property. You let me know who's closing the deal, and then we get plugged in with them. It's usually a title company, and then we work with that title company to make sure the documents are drafted, and they make the necessary changes on their end that we need. And then from there, you close the sale, and your clock starts ticking. So you have 45 days from that point to identify the new property, and 180 days total to make the purchase of the property.
Okay, I definitely have this as part of my question. So let's go ahead and dig deeper. 45 days to identify. What does that mean? What am I identifying?
Yeah, so you have to provide us with a list of properties with the either exact address or legal description of that property, so that it's just an IRS requirement. But we basically put that on file, say this is what the taxpayer identified, and then you're limited to purchasing just from that list. So that 45 days is very important because it's so quick.
Do you know, a question I didn't ask you when I was going through it is, what if I have more properties on my list that I've identified, but I don't actually close all of them?
Yeah, so the IRS has, well, they have rules to designating. So you can't just put, 100 properties on that list and then choose from a few of them. You are
I
limited
just
to
had a bright idea, but no, it's not going to work.
no, you're limited to either 3 properties. That's called the 3 property rule. Or if you list more than 3 properties, the total value of what you designate cannot exceed 2 times what you sold for. So if you sell for $1 million, you basically have like a $2 million cap space. So you could put 10 properties as long as the total value doesn't exceed that $2 million.
Okay.
Yeah.
Okay. That would be kind of like a complex and unique situation, right?
That's usually if you're moving from like a large investment to several smaller investments. So you're selling for $1 million, but you want to go buy 4 single family homes for $250 each. That's when you would list more than 3 properties.
Okay. Okay. That makes sense. So when you're saying identify properties, what types of properties are investors allowed to identify?
Right. So, the stipulation is that it's a like-kind property. It's what the IRS says. Like-kind for real estate is any other real estate. So it can be raw land for an investment, home. It could be oil and gas mineral interest for, raw land. It doesn't really matter. As long as you're exchanging a deeded interest in a piece of real estate for another one, then the IRS will accept it.
I think that anyone, if you've heard, been to any meetups or heard your peers talking about 1031 and you hear that like kind, it sounds way more serious than it is, right? Like it sounds like I'm buying a single family. I have to place the funds into another single family. But I learned through the process with you that like kind is very wide range.
Yeah.
And that you can actually go, and this is maybe, again, pretty niche, but you can go into a syndication that's pretty completely hands off. So there's so many different options.
Yeah, absolutely. And we do see a lot of those syndications on our end. If someone's selling a large piece of property, maybe they've owned it for a long time and they don't want to jump into being a manager of a new investment property. Syndications are popular because they take that management, out of the equation. You just are getting mailbox money basically and holding that investment.
Yeah, exactly right. We should bring on someone for syndications. Yeah, good idea. So, you guys in the audience, we have quite a few people on. This is awesome. If you've done a 1031, let us know. If you're thinking about doing one, let us know. If you have any questions, let us know. Y'all, Troy, he's done this a lot. He's incredibly efficient with these questions. So we're going to have quite a bit of time at the end. Go ahead and throw your questions. Speaker mumbles. Oh, you're speaking too fast.
I'm sorry. I'll slow it down.
Okay, we'll slow it down. So thank you, Deborah. Great feedback. If y'all have any questions, though, go ahead and ask them now because we will have some time at the end. So when people are looking for a custodian or intermediary, what would you suggest that they look for?
The number one thing I would always recommend is someone who's referred to you. So like you were to us, that way that that company has a good reputation. But other than that, you want to look for key things like segregated accounting. You want to make sure that you're going to have your own account set up with your funds in it and not have your funds commingled with any other clients. Another thing would be, for us, it's being part of the Federation of Exchange Accommodators, also known as the FEA. So that's kind of like the big group that lobbies for us in Washington. We kind of have a strict code of ethics as far as what we're able to do as a qualified intermediary. And so that's another important thing to look for in a QI because, that they abide by the same ethics as, the FEA that, provides. So
would every intermediary have to be part of that, or that's additional certification you have?
Right. That's an additional thing. So a lot of QIs, are lawyers or are accountants that just do it as like a sideline. But there are plenty of companies that do 1031 exchanges, only. So that's kind of where we fall, and it makes us an expert in that field.
Got it. And so when you say back to another thing you're looking for is that they don't commingle funds and that you have your own account.
Right.
So I was able throughout this process, email in within the same day, find out what is my current balance, because we actually sold one property and purchased 4 more. So the first example that you had.
Yeah.
And so I was able to, hey, Cindy, how much do I have left in my account?
Right.
And so that was a really easy process because, it was not commingled.
Right. And we can, of course, provide, bank statements to a lender. If they want to see a proof of funds, we can provide that, as well. So it helps to have all those things segregated so that we can pull, it has your tax ID number, your name on it. They know whose money it is.
Cool. You guys, let us know in the comments if you're here. I see a lot of people on, but no questions. So I want to be able to answer whatever you have. If you don't have any questions, then I'm just going to talk about my pets. That's what we do anytime. Oh, speaking of the devil, that's Pickles. So let us know. Have you ever done a 1031? Okay. Where do you see the future of a 1031 heading? Is there any chance they go away or double down or any?
Yeah, I mean, there's always a chance for it to get eliminated. It's always seen for as like a pay for tax cuts, because a lot of people in Congress, they think, well, this is where all of these tax dollars are going. They're just rolling them over instead of paying them. So, yeah, it's often looked at, but it's never really been, an imminent threat, so to say. But yeah, it's sometimes an issue. But really, the bigger thing for us is when interest rates go up so high and things really slow down. People are doing less exchanges. But yeah, I mean, it's still active, I guess. People are realizing that interest rates are what they are at this point, and they need to make some moves with their money. So we're seeing an uptick for now anyway.
Okay. Very cool. Let's talk about the cost that would be associated with an exchange.
Okay. Yeah. So our fee is a flat fee. It's usually around $1,000. That will include your sale and your purchase of the new property. Any additional purchases or sales in that same exchange would just cost a $200 document prep fee.
So
reasonable.
Troy, when you and I first talked about this, between the timeline and the cost, I was honestly pretty blown away because, I've spent 5 years going to meetups hearing about this, and it sounds a lot more daunting than it actually is. That, it's going to cost $10,000 and then you're going to take months of planning and all of this. And that was not my experience whatsoever.
Yeah, people are usually pleasantly surprised. It's usually that initial conversation is where all the work is, making sure it's going to work. If we need to tweak things in the beginning to, ensure that the finished product is within the IRS guidelines, that's where really the main stuff happens. Once we get it structured and we get plugged in with the title companies and attorneys, we just kind of take it from there in the background and keep you apprised of what's going on, and you call us if you have any questions.
Yeah. So talk to us, because there's really 2 takeaways I want to leave everyone with. The first is that it is less expensive and less complicated than you think. If you are considering selling a property and using those funds to buy more real estate, don't shy away from a 1031 exchange. It's really not that scary. The second thing I want to leave people with is that talk to us about what the actual tax savings could be.
Right. So your long-term capital gains is either 15 or 20%. And so that's what you would be deferring into the new property instead of paying, if you made $100,000 on a sale, you pay $20,000 to the IRS, you do a 1031 exchange, you save that $20,000 and you're able to roll it into the other property. So that's what we're looking at as far as capital gains go.
20% of your proceeds. 20% of your proceeds.
And it could be more if you have a state capital gains tax too. That's just the federal capital gains.
Y'all, that's a really nice family vacation. That is a huge down payment towards your dream car. That is, that's the whole car if you really wanted it to be. And I'm not saying you take the 20K and go spend it, but I'm just saying your savings
Right.
that you would be paying Uncle Sam going back into real estate regardless. Talk to us about if you do need some of your proceeds, but not all of your proceeds.
Yeah, so you're absolutely allowed to take out proceeds from the closing of the sale.
Okay.
There are constructive receipt restrictions once you do close the sale. So if you want money out, you have to let us know before you do close, because that way we can let the title company know, hey, they want, X amount of dollars out, and then send the rest to the exchange. But once it's in the exchange, we're limited to how we can use it. It's only for those replacement property purchases, and you only get it back once the exchange is over.
Got it. Okay, so that's super helpful. 2 main takeaways before we get into Q&A.
Okay,
Sorry,
okay, I was making sure you saw them.
Yeah, so I think that the Facebook comments weren't working for some reason, but they're all coming through YouTube. So we will do some Q&A.
Okay.
I want to recap the 20% savings, and it's not nearly as hard or expensive as you think it is. So if you walk away with 2 things, that's what I want you to walk away with. Okay. So let's look at some of these questions. Does the original property have to be in an LLC? I am going to answer that because mine was not in an LLC.
Yeah. No, the rule is just you have the same taxpayer on both sides. So if there is an entity that's selling, that same entity needs to purchase. Now, in the case of an LLC, if it's single member and disregarded for tax purposes, then you can go from an LLC to an individual or a married couple. And you can go back and forth as long as, again, it's disregarded for tax purposes. That's the key.
Okay. And is that something that on a consultation you would look at someone's individual situation?
Yeah, exactly. Yeah.
Cool.
That's something we go over here.
Awesome. And then a great one. So Adi asked, how long do you need to own the property in order to qualify? This is one that may get you.
Okay. So yeah, it's 1 year of holding time. So what you're deferring is long-term capital gains. And in order to qualify for long-term, you got to hold it for 1 year. That's the same thing on the purchase side of the new property. If you're going to do another 1031 exchange, you got to hold it for 1 year.
Talk to us about the occupancy during that year.
Okay. Yeah. So it can't, if it's an improved property, it can't just sit vacantly. It has to have at least 14 days of rental activity. And then your personal use is limited to 14 days a year. So you can't buy a beach house and stay in it 6 months and not rent it out.
This is not a workaround to like a slow flip or anything like that. You can't do a flip that, maybe you had some contractor issues, some permitting issues. It happened to take a year.
Right.
And all of a sudden you are trying to not pay your capital gains. It needs to be rented for 14 days.
Right. And another thing on that point is that you have to your intent must be to hold it for investment. So that's why another reason like flips don't qualify is because your intent is to resell it. Same thing with like a builder who builds homes. They're not doing 1031 exchanges every time they sell a house because it's considered their inventory by the IRS and not an investment property.
Perfect. And then Catherine asks, so for the exchange, the intermediary is actually a third party from your agent title. How do you plug into everything?
Yeah. So again, you have that initial conversation with us and then you just plug us in with either your real estate agent's fine, but preferably the title company or whoever's closing your sale. If you have an attorney working for you, that's fine also. We just need to get looped in on the transaction so we can make our tweaks and make sure that, the documents are drafted correctly.
I think that I literally texted Cindy who my title company was. It was pretty casual connecting all the parties together. Yeah, just as honestly a single initial group email would do it.
Yeah, exactly.
Yeah. And then this is one I love. So is there a limit to how many times you can defer? What's the little slogan?
Swap till you drop.
Swap till you drop. That's it. Yeah, I love that. So Is there a limit?
No, there's not. So again, you do have to wait that year tolling period, but once you've done that, you can exchange as many times as you want. And the swap till you drop, or can you defer until you die? Yes, you absolutely can. And what happens when you die is you get a step up in basis for your heirs. So instead of all that gain that you've been piling up over the years, you pass away, the heirs get fair market value of all your assets, and they could turn around and sell it the next day and not pay any taxes on the gain anyway.
I mean, you want to talk about asset protection and inheritance planning and all that. This is an ultimate tool of the wealthy.
Oh yeah,
Yeah.
absolutely.
Yeah, absolutely. So I don't have any kids to pass this to. I'm going to go blow all my money. But for those of you who are passing, funds down, your investments down to your children, this is a fantastic strategy to save really 20% of everything you've worked your entire career for.
Yeah, absolutely.
Yeah. But go sell a couple and go have some fun. Okay. Don't give it all to the kids. Then we have Miss Malika's asking, can you do a 1031 from LLC A to LLC B? And I'm assuming you're the owner of both.
Okay, if that's the assumption, then the answer is maybe. It depends on the ownership structure of those LLCs. You can't be more than 50% owner in the other entity that you're buying from. Otherwise, you get into a related party exchange, which is a more complex thing where the party you buy from also has to do a 1031 exchange. And you both have to hold your properties for 2 years. It's a weird related party rule, but that's how it works. So if you are 50% or 50% or more of LLC B and you sell out of LLC A, then it's fine as long as that LLC B is also going to do a 1031 exchange. But if you're 50% or less, then it doesn't apply to a related party. It's fine to buy. Does that make sense? It's a little complicated.
I am staring blankly. I don't personally understand that. Miss Malika, we're going to post Troy's contact info. So if this is something that you are considering on an individual basis, he or someone on his team will be happy to talk you through it. If y'all have any of these that's a very unique situation, feel free to reach out.
Yeah.
So here we go. Christian asks, does it apply to state taxes as well as federal taxes?
Yes, it does.
Okay.
You can defer that state tax as well.
Awesome.
Now, certain states will have clawback provisions. So I know California for sure does, but basically, if you ever sell that property, you do a 1031 exchange out of California and buy something in Ohio, and then you sell that Ohio property at 5 years later and don't do an exchange, California is going to want their taxes that you deferred.
Yeah. And that's a great point. Let's hit on when we say defer. Mm-hmm. If you don't swap till you drop and you eventually sell this asset, what happens at that time?
Yeah. So you'll pay taxes on all your deferred gain. So the way it works is the gain that you're deferring reduces the basis of the new property. So if you have $100,000 in gain and you go buy something for $500,000, your basis starts at $400,000.
Define basis.
The basis is how you calculate your capital gains. So your base is what you start at, basically.
Yeah.
And then all that money, you go up from there, and then you sell it. That's your gain in between your basis and what you sold for.
And so your basis would be your purchase plus improvements, capital improvements.
Yes, and minus depreciation. So
minus
you have to depreciation that as well. Yeah.
Awesome. So if you're holding this 27 and a half years, it could be fully depreciated, and your capital gains is the entire sale price, right? Not the capital gains, but it could be 20% of the entire sale.
Exactly. Yeah.
Yeah. Awesome. Okay. We have a couple more questions. Do Airbnb qualified anything to do with, yeah, right?
Yeah. Again, as long as those usage limits are met. So 14 days a year of renting it out, and you're personally not using it more than 14 days. Now, to touch on that personal use, the limits are actually the greater of 10% of the time it's rented or 14 days a year. So if you rented it 200 days that year, you could actually use it for 20 days for personal. But yeah, they do qualify.
I know this is being recorded, so, but how do they really know when you're there personally?
Well, so there's a famous story of a guy who did that, and basically, it was a really big deal. So the IRS was looking for a way to bust him. But it's the federal government. So they found out what cell phone towers he was pinging off of, looked at where he was filling up his gas, interviewed his neighbors.
Wow.
Basically pinned him down. So yeah, they have their methods if they need to.
Okay. So don't be silly. Don't spend 6 months and say you were there 2 weeks.
Right.
Okay. I love it. I love it. So other than everyone saying that Pickles needs an inheritance, he's not getting any of my real estate. Sorry. Pickles is the dog. So Troy, thank you. Is there anything you want to add before we wrap up?
No, I really appreciate you having me on. And again, I'm happy to answer any questions. Jesse will give you guys my contact information. So feel free to drop me an email or just call my direct line. I'll be happy to help you out.
Awesome. Awesome. Well, thank you. And thank you for shedding, putting a face to what could be seen as a really daunting process. And, so much of real estate is about who you know, the relationships, if you like working with someone. And I mean, the fact I was texting you questions like, 8 p.m. Maybe I shouldn't have been doing that, but, just texting you questions and like you made it so easy for us. And it really does come down to who you know and those relationships. So you now have a face for a 1031 exchange.
Here I am.
It's not scary.
Yeah.
So if y'all want to defer some capital gains, then you know who to reach out to. Awesome. Thank you.
Thank you.